Imagine waking up tomorrow and your bank is closed, not for maintenance, not for a holiday, closed permanently. Your debit card doesn't work. The ATM displays an error. Your online banking shows nothing. Every dollar you thought you had is suddenly inaccessible. This isn't a hypothetical disaster scenario. It has happened repeatedly throughout history. In 1933, Franklin Roosevelt declared a bank holiday and shut down every bank in America for 4 days. In 2013, Cyprus froze bank accounts and seized deposits to prevent collapse. In 2001, Argentina locked people out of their savings for over a year. In 2008, banks that seemed invincible vanished overnight. And here's what most people don't understand. When banks close, they don't reopen with your money, waiting for you. The money was never there. Banks operate on fractional reserves, meaning they only keep a tiny fraction of deposits on hand. The rest has been lent out, invested, or leveraged into financial instruments. If everyone tried to withdraw at once, the bank would run out of cash within hours. This is the story of what actually happens when the banking system shuts down, who survives, who doesn't, and why the next shutdown might be closer than anyone wants to admit. When you deposit $10,000 in a bank, you assume it's sitting in a vault somewhere with your name on it. It's not. The bank is required to keep only a small percentage as reserves. In the United States, that percentage was 10% until 2020, when the Federal Reserve reduced it to zero. Zero. This means if you deposit $10,000, the bank can lend out all $10,000 immediately. They credit your account with $10,000 in digital numbers, but the actual cash is gone, lent to someone buying a house or car or starting a business. This works fine as long as not everyone wants their money at the same time. Banks profit by paying you 1% interest on savings while charging borrowers 5% on loans. The spread is their profit, but it's based on an assumption that deposits and withdrawals will roughly balance over time. When that assumption breaks, the system collapses. If 20% of depositors demand cash simultaneously, the bank doesn't have it. This triggers a bank run. People hear the bank is in trouble and rush to withdraw before it's too late. This accelerates the problem because every withdrawal makes the bank weaker, causing more people to panic. History is filled with images of bank runs, crowds storming buildings, people fighting for access to tellers, banks barricading doors. These aren't scenes from the Great Depression alone. They happened in 2008 when Northern Rock collapsed in the UK. They happened in 2013 in Cyprus. They happened in 2023 when Silicon Valley Bank failed. The fundamental fragility hasn't changed. Your deposits are promises backed by the assumption that you won't ask for your money when everyone else does. And when that assumption fails, the promise breaks. On March 4, 1933, Franklin Roosevelt was inaugurated as president during the worst banking crisis in American history. Over 5,000 banks had failed in the previous 3 years. Depositors had lost billions. Panic was spreading. Roosevelt's solution was radical: shut down every bank in the country. On March 6th, he declared a national bank holiday, closing all banks for 4 days while Congress passed emergency legislation. The goal was to stop bank runs and restore confidence. During those 4 days, Americans had no access to their money, no withdrawals, no transfers, no banking services. Cash on hand was all anyone had. Businesses that depended on daily deposits couldn't operate. Workers couldn't cash paychecks. Commerce ground to a halt. The government inspected banks and only allowed the sound ones to reopen. About 2,000 banks never reopened. Depositors in those banks lost their savings. There was no FDIC insurance yet. If your bank failed, your money was gone. The bank holiday worked in the sense that it stopped the immediate panic. But it also proved that the government could freeze the entire banking system overnight. Once that precedent was set, it could happen again. In 2013, Cyprus faced a banking crisis. Its banks had invested heavily in Greek debt, which had become worthless. The banks were insolvent, holding far less in assets than they owed to depositors. The solution imposed by the European Union was a bail-in. Instead of taxpayers bailing out the banks, depositors would pay. The government froze all bank accounts, imposed capital controls preventing transfers out of the country, and then seized a percentage of deposits over 100,000 euros, Cypriots woke up to find their savings confiscated. A business owner with 500,000 euros in the bank lost nearly half of it overnight. The government called it a tax. Depositors called it theft. Either way, the money was gone. Greece followed a similar path in 2015. Banks closed for weeks. ATMs were limited to 60 euro withdrawals per day. Capital controls prevented moving money out of the country. People couldn't pay bills, buy supplies, or conduct normal business. The economy seized up. Argentina experienced an even longer freeze in 2001. The government locked bank accounts, prohibiting withdrawals above tiny amounts. The Corralito, as it was called, lasted over a year. Middle-class Argentinians who had saved for decades watched their purchasing power evaporate through inflation, while their savings remained trapped. These weren't third-world countries lacking financial infrastructure. Cyprus was in the European Union. Greece used the euro. Argentina had been considered an emerging economic power, yet their banking system shut down and depositors paid the price. The pattern is always the same. Banks overlend or invest recklessly. A crisis exposes their insolvency. Governments freeze accounts to prevent bank runs. And depositors discover that their money was never really theirs. When banks shut down, the first 72 hours are chaos. Most people's wealth exists as digital numbers in bank accounts. When those accounts become inaccessible, the economy stops. Your debit card doesn't work. Credit cards may be declined if the bank can't verify funds. Online payments fail. Direct deposits don't arrive. Automatic bill payments bounce. If you don't have cash in hand, you can't buy anything. Grocery stores would empty within hours. Not because there's no food, but because people panic buy when they realize they might not have access to money. Those with cash stockpile, those without can't purchase. Gas stations would close or accept cash only. Transportation would become difficult. Supply chains would break down because truckers can't buy fuel and suppliers can't pay workers. ATMs would be drained immediately. Lines would form at any machine still dispensing cash. Banks would limit withdrawals or shut down ATMs entirely to preserve remaining cash. Businesses would struggle to pay employees. Without access to funds, payroll fails. Workers show up and can't be paid. Many would stop working. Essential services like hospitals and utilities might continue on credit or government assurance, but many businesses would simply close. Crime would spike. When people can't access their money and can't buy necessities, desperation sets in. Looting, theft, and violence increase. Those with visible cash become targets. The government would likely impose emergency measures, capital controls preventing money from leaving the country, withdrawal limits, mandatory business closures to prevent panic, possibly even martial law in cities where civil order breaks down. This isn't speculation. This is what happened in every banking crisis. The first 72 hours separate those who prepared from those who didn't. When banks shut down, two groups emerge: those who had assets outside the banking system and those who didn't. The survivors held cash at home. Not all their wealth, but enough to cover weeks or months of expenses. When ATMs failed and cards stopped working, they could still buy food, fuel, and necessities. They held precious metals. Gold and silver retain value when currency fails, or banks close. In Argentina during the Corralito, those with gold could trade it for goods, or sell it for whatever currency still functioned. Those with only bank deposits were trapped. They owned productive assets: land, businesses, tools, equipment. Things that generate value regardless of what happens to banking systems. A farmer with land can still grow food. A mechanic with tools can still trade services. Someone whose wealth exists only in a frozen bank account has nothing. They had diversified internationally. Money in multiple countries, accounts in different jurisdictions, assets that couldn't be seized by a single government. When one system froze, they had access to others. The losers were those who trusted the system completely, who kept all their money in banks, who believed FDIC insurance meant their deposits were safe, who assumed banks would always be open and cards would always work. In Cyprus, small depositors under 100,000 euros were theoretically protected, but they still couldn't access their money during the freeze. Protection doesn't help if you can't buy food while waiting for the bank to reopen. In Greece, deposits were insured but trapped. You had wealth on paper, but couldn't use it. The difference between having money and having access to money became brutally clear. The pattern repeats. Those with assets outside the banking system survive banking shutdowns. Those dependent entirely on banks suffer. After 2008, governments learned that bailing out banks with taxpayer money was politically toxic. The public hated watching banks get rescued while ordinary people lost homes and jobs. So they developed a new approach: bail-ins. Instead of taxpayers rescuing banks, depositors would pay. This became official policy in the European Union, Canada, and several other jurisdictions. Here's how it works. When a bank becomes insolvent, instead of closing it or using government money to save it, depositors' accounts are converted into bank equity. Your savings become shares in a failing bank. The bank stays open, but your deposits are wiped out or severely reduced. This was tested in Cyprus and established as precedent. It can happen anywhere that's adopted bail-in legislation. And most depositors have no idea this is now official policy. FDIC insurance in the United States covers deposits up to $250,000. But the FDIC only has about $125 billion in reserves. Total insured deposits exceed $10 trillion. If multiple major banks failed simultaneously, the FDIC couldn't cover the losses. They'd need a government bailout themselves, or depositors would lose money despite insurance. During shutdowns, governments also impose capital controls. You can't move money out of the country. You can't convert currency to other currencies. You're trapped in whatever system is collapsing. They may also force conversion to new currency. Argentina has done this repeatedly, converting peso deposits to new pesos at unfavorable rates, effectively confiscating a percentage of everyone's savings. Or they simply allow inflation to destroy the value of frozen deposits. Greece's depositors eventually got access to their euros, but by then, inflation and economic collapse had eroded purchasing power. The lesson is that government protection is conditional and limited. When the system is in crisis, the rules change. Insurance may not pay, accounts may be seized, promises may be broken, and depositors discover that their rights are subordinate to systemic stability. The push toward cashless societies makes banking shutdowns more catastrophic. When all money is digital and all transactions run through banks, a banking shutdown means complete economic paralysis. Sweden is nearly cashless. Over 90% of transactions are electronic. Many businesses don't accept cash at all. If Swedish banks shut down, the economy would freeze completely. No fallback, no alternative. Total dependence on a system that could fail. China's digital payment systems, Alipay and WeChat Pay, dominate commerce. If those systems went down, hundreds of millions of people couldn't buy anything. The government controls those systems, meaning they can freeze anyone's money instantly. Central bank digital currencies, CBDCs, being developed worldwide would complete this control. Every unit of currency would be digital, traceable, and controllable. Governments could freeze accounts, limit spending, or confiscate money with a keystroke. When banking shutdowns occur in cashless societies, there's no alternative. You can't withdraw cash because cash doesn't exist. You can't trade physical money because no one has it. You're entirely dependent on the system functioning, and when it doesn't, you're trapped. This is presented as convenience and efficiency, but it's also vulnerability. A society that has eliminated cash has eliminated the escape valve that allowed people to survive banking crises throughout history. When banks shut down, who pays? Depositors, small businesses, workers, ordinary people, whose wealth is trapped in frozen accounts. They lose access to their money, suffer economic hardship, and often see their savings devalued or confiscated. Who profits? Those who anticipated the crisis, wealthy elites who diversified internationally before capital controls were imposed, insiders who moved assets out before the freeze, those with physical gold and silver who can trade outside the banking system. Banks themselves often emerge stronger. After forced mergers and bailouts or bail-ins, the surviving banks are larger and more dominant. Competition decreases. Too big to fail becomes even bigger. Governments gain control. Banking crises justify emergency powers, capital controls, and expanded surveillance. Temporary measures become permanent. The crisis is solved, but freedom is reduced. And the pattern repeats. The system that failed gets rescued, reconstituted, and continues until the next crisis. The underlying fragility, fractional reserve banking, excessive leverage, poor risk management, remains unchanged. Banks in 1933 shut down. Depositors lost access. Some banks never reopened. Savings vanished. Cyprus in 2013. Accounts frozen. Deposits seized. Capital controls imposed. Greece in 2015. Banks closed. ATM limits. Economic paralysis. Argentina in 2001. Accounts locked for a year. Savings destroyed by inflation. The pattern is identical across decades and continents. Banking systems built on fractional reserves and excessive leverage eventually fail. When they do, governments freeze accounts, impose controls, and depositors pay the price. The only difference today is the scale. The financial system is more interconnected, more leveraged, and more dependent on digital infrastructure. The next shutdown could be global. And unlike 1933, when most people had cash and local economies could function, today's cashless, digitally dependent world would face total paralysis. First, understand that bank deposits are not as safe as you've been told. FDIC insurance has limits. Bail-in legislation allows governments to convert your deposits to worthless equity in failing banks. When crisis hits, the rules change, and depositors pay. Second, diversify outside the banking system. Hold some physical cash for emergencies. Own precious metals that retain value when banks close. Invest in productive assets, land, businesses, skills that generate value regardless of financial system stability. Don't keep all your wealth in one bank or even one country. Third, recognize that the trend toward cashless societies increases vulnerability. The convenience of digital payments comes with complete dependence on systems that can fail or be shut down. Maintain some independence from the digital financial grid. Banks have shut down before. In 1933, in 2001, in 2008, in 2013, in 2015, and they will shut down again. The only questions are when and how prepared you'll be. When it happens, most people will be caught completely off guard. They'll wake up to frozen accounts, non-functioning cards, and empty ATMs. They'll discover that their wealth was never really theirs, just numbers in a computer that can disappear with a policy change. Those who prepared, who held cash, owned physical assets, and diversified internationally will survive. Those who trusted completely that the system would always work will pay the price for that trust. History doesn't repeat, but if you don't understand it, it will crush you all the same. Banks have always been fragile. The next shutdown is not a matter of if, but when. And the difference between surviving it and being destroyed by it is what you do before it happens. If this gave you a new perspective, hit subscribe. History has the answers, and I'll show you where to look.